Hey everyone! Today we are going to pull back the curtain on one of the most powerful and honestly most misunderstood ideas in all of finance, derivatives. They're kind of like this hidden force that shapes a lot of our financial world, so let's jump in and demystify them together. I want to start with a number that is, well, it's almost impossible to really wrap your head around it. $1,200 trillion. That is the estimated notional size of the global derivatives market. To put that into perspective, that number absolutely dwarfs all the world's stock markets combined. It's just staggeringly, mind-bogglingly huge.
So what is this gigantic, mostly invisible market? Yep, it's the world of derivatives. And in this explainer, we're going to break down exactly what they are, why on earth the market is so enormous, and how these things are actually used to try and manage risk across our entire financial system.
All right, let's start with the absolute basics. Before we can get why this market is the size of a planet, we really need a solid definition of what a derivative even is.
Okay, so here's the core concept. When you buy a stock, you're buying a piece of ownership in a company, right? It's a thing. A derivative is different. It's just a private contract between two people, and its value isn't based on what it is. Its value is derived from something else, an underlying asset. That could be a stock, a bond, the price of oil, interest rates, you name it.
So you might be wondering, okay, so it's a bunch of side bets. Why is that market so massive? And that's a great question. The answer really comes down to its main purpose: to manage, to control, and to tame the financial risks that are just a part of living in an uncertain world.
To really get this, let's use a super simple example. Picture a wheat farmer. Her crop is going to be ready in 3 months, but she has absolutely no idea what the price of wheat will be then. If the price just plummets, her entire year's worth of work could be wiped out. That is a huge risk.
So what can she do? Well, her solution is one of the most basic derivatives there is, a forward contract. She finds a buyer today, and they agree on a price for her wheat that will be paid 3 months from now. And just like that, boom, she's locked in her price. She has completely eliminated the risk of a price drop. This is the perfect illustration of what derivatives are designed to do.
Now, forwards are fantastic, but they're private, they're customized, and they can be a little clunky. So the market evolved a more efficient version called a futures contract. As we can see here, futures are standardized. They're traded on an open exchange, which makes them way easier to buy and sell. And, this is critical, the risk is managed by a central party, a clearinghouse, which we are definitely going to talk more about in a bit.
All right, next up in the toolbox, we have the swap. Imagine you're a bond fund manager. You get these nice, steady, fixed interest payments from your bonds. But you're worried that interest rates are about to go up, which would make your bonds worth less. You can use a swap to trade your fixed payments for variable rate payments, protecting yourself from that exact risk.
Then we get to options, and these add a really fascinating layer of flexibility. An option gives you the right to do something, but, and this is the key, you are not obligated to do it. A call is the right to buy, and a put is the right to sell. The power here is that you have a choice.
So what's a great real-world use for this? A protective put. If you own a big stock portfolio, you can buy a put option. This gives you the right to sell your stocks at a price you agree on today. So if the market crashes, your option basically acts as a safety net, protecting you from those catastrophic losses. It is, quite literally, portfolio insurance.
Okay, so who are the folks using these powerful tools? Well, they generally fall into two main camps, and they have very, very different reasons for being here. You have hedgers and you have speculators.
And what's so fascinating is just how different their motivations are. Hedgers, like our farmer, are trying to get rid of a risk they already have. They want protection. They want stability. Speculators, on the other hand, are willingly taking on risk. They are making a bet. They are gambling on which way prices are going to move because they hope to make a profit. Let's see how a professional hedger would actually use this stuff. Imagine a fund manager. She's got a $20 million stock portfolio, and she's getting nervous. She thinks the market might be about to take a nosedive, but selling off all those stocks would be expensive and a huge hassle.
So she turns to derivatives. First, she has to assess her risk. Her portfolio is worth $20 million, and it has a beta of 1.2. All that means is it's about 20% more volatile than the overall market. So she chooses index futures as her tool. And then she does the math to figure out the exact number of contracts she needs to sell to perfectly offset her risk.
And the calculation tells her she needs to sell 120 stock index futures contracts. See, this isn't a guess. It's a precise, mathematical shield designed to neutralize the specific risk of her portfolio.
And this is where you see just how powerful a hedge can be. Let's say the market does fall, and her portfolio loses nearly $1 million, $960,000. Ouch. But because she sold those futures contracts, her derivative position makes an equal and opposite profit of $960,000. Her net loss? Zero. The risk has been completely and totally neutralized.
But all of this works based on one giant assumption, that the other person in your contract is actually going to pay you what they owe. So what happens if they can't? What happens when your counterparty bails on the deal?
This is what's known as counterparty risk, and it's really the Achilles heel of any private, over-the-counter deal. A derivative is only as good as the other person's ability to pay up. If they go bankrupt, your contract, your perfect hedge, could become completely worthless overnight.
So yeah, this was a huge problem, and the financial system had to come up with a really clever solution, a kind of safety net to protect the integrity of the whole market.
And that solution is the clearinghouse. You can think of it like a referee, or the ultimate middleman that stands between every single buyer and seller. The clearinghouse becomes the counterparty to everybody. It guarantees that if you went on a trade, you are going to get paid, period.
And how do they do this? Well, they use multiple layers of protection. They make everyone post collateral, which is called margin. They value every position every single day, and if you're losing money, they make you post more collateral. And just in case something truly catastrophic happens, they have these massive guarantee funds to cover defaults. It's all designed to build a much safer, more stable system.
And so, that brings us full circle. Derivatives are these unbelievably powerful tools. They allow businesses and investors to slice and dice risk with surgical precision. But when they're used for speculation without the right safeguards in place, they can also create and concentrate risk in really dangerous ways. So the question for all of us is, how do we best harness their incredible power while containing their potential for harm?